Today we are going to start accounting from scratch and our topic is basic accounting concepts. In this lesson, I will introduce you the concept of accounting, definition of accounting, and then we will discuss few terms. This is the basic concept. Gradually we will move on. So you will learn accounting in this subject. So accounting is a systematic process. See, the focus is the word systematic process of identifying, analyzing, recording, classifying, summarizing, interpreting, and communicating the financial information, right? So in accounting, we identify, analyze, recording. These are all the terms which I will explain to you one by one. What is the meaning of identifying? What is the meaning of analyzing? How we do recording? How we do classifying? Gradually when we will move on to the next lessons, right? So this is the basic definition of the accounting. If you will see in different books, you will see different accounting definition, but the basic concept is this: whatever financial information you have, which we call transaction, you have to identify what type of transaction it is, then you have to analyze, record, classify. What all you have to do these things of the financial information, or you can say the system of recording and summarizing business and financial transactions and analyzing, verifying, reporting the results, right? Both definitions have the same meaning. In different books, you can find out definitions in different ways, but the basic concept is this. In our daily life, we do accounting. Suppose if you go to mall and you do some shopping, sometimes we buy the product, sometimes we sell the product. So this is the kind of accounting, and this is called the transaction. If we buy our daily routine things, suppose grocery, right? So is a called a transaction because we pay cash and then we receive the items. Sometimes we use the credit card and then we receive the items, right? So these are called transactions. In business, how you record these transactions, how you classify these transactions, how to summarize these transactions, this is called actually accounting. And accounting is the easiest subject, but the thing is you have to pay attention. So I ask you to memorize this definition, or at least you can read 3 and 4 times. So when we will move on to the next lesson, I will use the word classifying, summarizing, recording. So at least you should know that we have learned all these terms in the first lesson. So I will repeat one more time the definition of accounting for you. Accounting is a systematic. Okay, now what is the meaning of systematic? That first of all, you have to identify the transaction. One by one you have to do analyze, then recording. You cannot jump to summarizing. If there is transaction and we are going to summarize the transaction, then we are coming to identify the transaction, then we are going to recording the transaction. No, is a systematic way or a systematic process of identifying, analyzing, recording, classifying, summarizing, interpreting, and communicating financial information. So simple. In order you have to go, right? And we will learn this order one by one. Accounting is also called the language of a business, right? In our daily life, when we go to the mall, when we buy anything, we are not saying that we are doing accounting. Actually we do transactions, but we don't say it. But it is the language of a business. If you have a business, when we will record the transactions, when we will make the financial statements, which are called the balance sheet or the income statements, these statements we will also learn gradually. So accounting is also called the language of a business. Now, what is the purpose of accounting? The purpose of accounting is to provide accurate information, accurate accounting information for decision making. When we make our profit and loss statement, which is called the income statement, so on the basis of income statement we make the decision whether our business is growing, whether our business is profitable, or we are going on a loss side. Similarly, when we will make the balance sheet, we will see what type of assets we have, what how many liabilities we have, and owner's equity. So the purpose of accounting is to provide accounting information for decision making. We make decisions on the basis of our statements. So accurate information, this is the important part, that accurate information is required for many purposes, because when we file our income tax, when we make our profit and loss statement, so accurate information should be recorded, right? So accounting system is an organized method of performing accounting tasks. Every accounting system must record the day to day activities of the business. Suppose if you have a business, any type of business, whatever activities you are doing, if you are purchasing supplies for your business, if you are purchasing equipment for your business, if we are selling something related to the business, you have to record on daily basis. How we will record, I will explain it to you in the next few lessons, right? Because this is the basic, we are learning the basic terms of the accounting. Summarize and report information in financial statements. See financial statements, there are different kind of financial statements: balance sheet, income statement, cash flow statements, etc. Again, I say that we will discuss this one by one for analysis and decision making, right? First, every accounting system, so these are the important point, that every accounting system has to record their activities, has record the transactions on daily basis. Then monthly or quarterly or at the end of the year, we have to present our financial statements. On the basis of financial statements, we make decision. Now is the business entity assumption. One term we use in accounting which is called the business entity assumption. See, it looks that it is a difficult, but it is very easy concept. What does it mean? It means, suppose if you have two businesses, if you have three businesses, all the receipts, all the accounting work of should be separate, right? If suppose you have business A, business B, so you have to make financial statements of businesses separate and for the other business separate. In order to prepare accurate financial statements, the financial data for the business must be kept separate from personal financial data. Even from your personal financial data, if we are doing transactions for our daily life, that should be kept separate from your business. Each business should be considered as a separate unit or entity for the purpose of keeping accounting records. This is known as the business entity assumption. So simple, right? What is business entity assumption? Each business should be considered as a separate unit or separate entity, and you have to do separate accounting of each business. This is called the business entity assumption. Now another term which is called GAAP, generally accepted accounting principles. So what is GAAP? GAPs are rules and regulations which accountants have to follow when they make the financial statement, when they do the accounting. You have to follow GAAP. So GAAP, see, generally accepted accounting principles are underlying assumptions, provide a set of consistent rules used by all accountants to prepare financial statements such as balance sheet, cash flow statements, income statement, etc. You have to follow GAAP. These are the rules and regulations or principles. Okay, next is the accounting equation. So accounting starts from here. Very important. Accounting equation, or it is called the balance sheet equation. Balance sheet equation. If someone asks you what is the balance sheet equation, accounting equation, both have the same meaning. Assets is equal to liabilities plus owner's equity. See, this is equal to sign, and here on the left hand side we have assets, on the right hand side on the balance sheet we have liabilities, owner's equity, or we say capital, right? Whatever the name of the business, owner's equity, Ahmad or Raj, or capital of Raj, whatever. So assets is equal to liabilities plus owner's equity. Suppose if you are going to start a business and you have 10,000, you have invested 10,000 in your business. Out of these 10,000, suppose 4,000 is the liability. You have a loan of 4,000. So how much out of these 10,000, how much is your money, owner's equity? 6,000. It means 6,000 is called the owner's equity. Both side, when you will add liabilities plus owner's equity, it should be equal to the asset side. Left hand side must be equal to the right hand side. That is why it is called balance. The word balance shows both sides should be equal. Balance sheet equation, assets always equal to liabilities plus owner's equity, and this is the basic concept of the accounting. Accounting is, you can say the accounting starts from the balance sheet equation. Assets is equal to liabilities plus owner's equity. Now I will explain to you one by one these terms. What is the meaning of assets, liabilities and owner's equity? Assets are items of value owned by a business. Suppose if you are going to start a business, you have a cash. You have a cash of 5,000, suppose. You have a bonds, you have office supplies, you have purchased some equipment for your businesses. So whatever you have related to your business is called, it is your asset. Now liabilities are dates of a business or a person. Similarly, I told you in this case, if suppose you are going to start a business with 10,000, in this 10,000, 6,000 you have invested, 4,000 suppose you have borrowed from your friend or from the bank or from the financial institution, which is called the liability which you have to pay. So total assets minus liabilities, whatever is remaining is the owner's equity. So out of this 10,000, 4,000 is the liability. You invested 10,000, but in 10,000, 4,000 is the liability. 10,000 belongs to you. That is why both sides are equal. Owner's equity. Owner's equity is a person's net worth, or the difference between items owned and dates owed. Item owed means assets, whatever asset you have, items owned, and dates owed, whatever liability you have. When you subtract, see 10,000 minus 4,000, which is equal to 6,000. So this is the owner's equity. Moving on, so balance sheet. A balance sheet is a financial statement that lists the assets, liabilities, and owner's equity as a specific date. This is one of the most important feature of the balance sheet, that we make the balance sheet on the specific date. And in balance sheet, always you have to write down assets, liabilities, and owner's equity. These three items. If you have expenses, if you have revenue, these are not part of the balance sheet. Assets, liabilities, and owner's equity is the part of a balance sheet. Owner's equity is the owner's claim against the assets of the company, right? The company, suppose the company's financial position can be described in terms of the accounting equation or balance sheet. Suppose you have 80,000, you have invested 80,000 in your business, so your assets are 80,000. Out of these 80,000, 30,000 are liabilities. You have borrowed 30,000 from the bank, 50,000 you have invested, so total your assets are 80,000. So assets is equal to liabilities plus owner's equity. If suppose I say 80,000 is your assets, 30,000 is the liability, what should be the amount of owner's equity? Then you have to subtract 80,000 minus 30,000, which is equal to 50,000. Why? Because these both left hand side should be equal to the right hand side. 80,000 is equal to 80,000. The total of the left hand side equals to the total of the right hand side. That is why it is called balance sheet equation or accounting equation, right? So if suppose you know the assets, you know the equity, you do not know the liability. So what you have to do, again you have to subtract 80,000 minus 50,000, which is equal to 30,000 is the liability. Now here I have made balance sheet, so you can see easily and you can understand. Always you have to write down the business at the top, right? Then you have to write down the statement and then date. So these three part is called three W's, right? These are called three W's. Now what is the meaning of three W's? First of all, this one you have to write down the business name. So this is who, this is the first W. Then you have to write down the business name. Second is balance sheet. What statement you are making? You are making balance sheet, income statement, trial balance, cash flow statement. What? In second line you have to write down what. And third is when you are making. So that is why it is called three W's, and it should be at the center of the page, and it should be in sequence. You cannot write down date at the top, then balance sheet, then business name. No, first of all you have to write down the business name, then what you are making, then when you are making, who, what and when. That is why it is called three W's. Now on the left hand side you have to write down the assets, on the right hand side you have to write down liabilities and owner's equity. But if you want, we can make a report form. Just here I have written assets. After assets you can write down liabilities and owner's equity, which we will discuss later. But here is the simplest form, assets, and then in assets you have to write down cash on the top. Again you have to write down assets in a sequence, and I will show you what is the sequence. Cash, suppose you have 10,000, accounts receivable 12,000, supplies you have 4,000 in the business, total of your asset you have 80,000, right? This single line means that this is the total of the column. So total of this column is 80,000. When you will finish everything, see there is a double line. Double line means ending balance. Now you cannot write down here anything. This one is the column total, this one is the ending total. Come on the liability side, again we have to write down the liabilities first, and liabilities we have to write down in the sequence, which I will show you in the next slide. Accounts payable, loan and mortgage payable, these are the liabilities. Make the total. Single line means total of this column is 35,000. If you know only 35,000 and 80,000, what is the owner's equity? 80 minus 35, which is equal to 45, right? So owner's equity, Robert's capital, which is called, is 45,000. Again single line. See, if I am not making double line here, it is only single line. Why? Because on the other side, liabilities plus owner's equity should be equal to the assets. So we have to add this and this. If I will put double line here, it means I cannot add this to the owner's equity. It is open 35 and 45, 80. After 80, I have to close it with the double line, total liabilities and owner's equity. Always keep in mind, balance sheet should be very attractive, because you have to present their balance sheet inside the organization, outside the organization. So it should be very attractive. And one important thing is, there is no need to write down dollar sign with each and every figure. Just write at the beginning of each column. So this is first column. Here you can write down dollar sign, and then you have to write down dollar sign at the end of the total. Second important thing is, total assets and total liabilities and owner's equity should be in the same line. See, suppose my all assets are finished here, I cannot write down total assets here and then total liabilities here. No, it should be in the same line, because we have to make it attractive. Right, so what I told you, these three are called the three W's. You have to write down at the top in same order: first name of the business, then what you are making, when you are making, assets, liabilities and owner's equity. So prepare a statement heading. These are the same thing which I have explained to you. The three lines heading is centered at the top of the page and is designed to provide information: who, what and when. which we already discussed. List assets. Assets are listed and total on the left side of the page or equation. Liabilities are listed on the right side. See, this is the left side and right side. Owner's equity. Owner's equity section showing the owner's investment. It is also on the right side of the equation after the liabilities section. This is also important. You cannot write down Robert's capital first and then liabilities. No, there it should be. I told you in the beginning, accounting is a systematic process. You have to follow the system. First assets, then liabilities, then capital. Right? Okay. And then the final total of each side must be on the same line, which shows that the left side of the balance sheet should be equal to the right hand side, or we can write down, instead of complete assets, A is equal to L plus OE, owner's equity. Here points to remember: the total assets and total liabilities and owner's equity are written on the same line, which I have told you, like this. You cannot write down total assets here, then liabilities here, then equity here. It should be attractive. No abbreviation should be used in the statements. The statement means balance sheet, income statement, cash flow statement. If you are making a balance sheet, you cannot write down BS, balance sheet, income statement, trial balance. No, right? You have to write down complete word: balance sheet, income statement. The statement should contain no correction. If suppose this is 80, by mistake you have made 88, so you have to make it again. You cannot write down, okay, correct, means you cannot make the correction on the statement. No correction. You have to erase it or you have to make it again. Why? Because it should be attractive and accurate. It means maybe another person did this. For the balance sheet, dollar sign should be placed as follows: beside the first figure in each column, beside the final total on both sides of the statement, which I have already showed to this one. And here no need to write down dollar dollar again. It should be on the same line, right? No correction is required. And here balance sheet, you have to write down the complete name what you are making. You cannot write down the abbreviations. Now, few accounting terminologies. Cash. Remember, I told you that first of all you have to write down cash. If suppose you have a currency bills, if you have a coins, bank deposit, no need to write down all these one by one. These all are considered as a cash. So always cash you have to write down at the top of the balance sheet, the first item. Now, what is accounts receivable? The total amount due from debtors customers. Suppose if we sell something, so we have to receive something from the customer, so that is called accounts receivable. If you have a business, you are selling something and your customers are buying products on credit, so this is called the account receivable. Debtors are persons or businesses that owe a business money as a result of purchasing goods and services. Accounts receivable is normally due within 30 days. That is why it is after cash. Office supplies, these are purchased for business purposes. Now accounts payable. What is the difference between account receivables and accounts payable? The total amount owed to the creditors for the purchase of goods or services. Suppose if you have a business and you purchase something on credit, you can take the example of a credit card. When we use the credit card, we have a grace period of 30 days or 40 days. We have to pay on that period. This is called the accounts payable. When we sell something on credit, we have to receive from the customer. That is called the account receivable. But when we purchase something on credit, then we have to pay. This is called the accounts payable. And bank loan, the amount of loans owing to the bank. These loans vary in length from 1 to 5 years, right? If suppose you are buying an equipment or a land or a building for your business, so we take loan. If it is 1 year or less than 1 year, so it is called the current, otherwise it is called the long term loan. Mortgage payable, the amounts borrowed from financial institutions, usually to purchase building or land. This is called the mortgage payable, and mortgage is maybe 15 years or 20 years or 30 years. right? And then is the cost principle, very important. Cost principle, the cost principle says that assets to be recorded at their actual cost. Now what does it mean? Suppose you have purchased an equipment for your business for 6,000, its value is 6,000, so you have to record 6,000 in your books, in your accounting system. Whether it's cost after 1 year or 2 year, maybe it is 10,000 or 20,000, whether it increases or decreases, you have to record the actual cost at which you have purchased. This is called the cost principle. Cost principle says that assets to be recorded at their actual cost, not the increased cost or decreased cost. Now, order of items on the balance sheet. When we make the balance sheet, you have to make this order. These are the few accounts. Individually, these are called the accounts. These are the few accounts. Gradually, when we will move on, I will introduce you more accounts. So cash, always you have to write down at the top. You have to arrange all these accounts in the liquidity position. Liquidity position means if you have some accounts which you can convert easily into cash, right? Cash, accounts receivable, you have to receive from the customer, so usually we receive in 30 days, we can convert into cash easily, is called the current assets. And these are the long term or fixed assets. Suppose if we have a building, if we have a land, if we have a equipment, and we want to sell it, we can sell, but we cannot convert easily these items into cash. That is why it is called the fixed assets. First you have to write down the assets which you can convert easily into cash. So same thing here, I have mentioned assets are listed in order of their liquidity, which means the order in which assets can be converted into cash. When the assets are converted into cash easily or within 1 year, it is called current assets. When the assets are converted into cash not easily or last a long time and are used for a long period of time to operate the business, is called the fixed assets, right? So keep in mind, always you have to write down cash at the top because it is in your hand, and then account receivable, and then road receivable. I will introduce you more accounts later. These are the patterns. Similarly, liabilities, you have to write down in the liquidity position. First you have to write down accounts payable because these are payable within 30 days. Loan, normally 1 to 6, not 1 days, it should be, means sometimes if it is a bank loan it is 1 to 6 years, right? And then mortgage payable, mortgage we usually 20 years, 15 years, 30 years. So you have to write down the liabilities account in order. Liabilities are listed according to their payment due date from most recent to the longest term. So most recent is 6,000, which is payable within 30 days. This is payable 1 to 6 years. This is payable in 30 years. This is known as the maturity date, that this loan will mature in 30 days, this loan will mature in 1 to 6 years. So you have to write down like this, right? And now I have set some practice problem for you. Whatever I have explained to you, whatever we have discussed, I have made a very simple questions for you. Complete the following equations. Assets is equal to liabilities plus owner's equity. Suppose assets you have 10,000, liabilities you have 4,000. You have to find out the owner's equity. And keep in mind, balance sheet, both sides should be equal. So 10,000 minus 4,000, here will be 6,000. Both sides should be equal. This is called the balance sheet. In the second, assets are missing. Here owner's equity is missing. So if one is missing, you can find out by adding or by subtracting the other, right? So you have to do this. Then move on, question number 2. Classify the following items as an asset, liabilities or owner equity. These are the items and you have to write down what is cash is the assets, accounts payable is the liability. You have to figure out. This is the practice problem. Question number 3 is the assets and liabilities of Ahmad Engin given below. See, these are not in order. What is the requirement? Arrange the items of the balance sheet. You have to arrange it. You cannot make your balance sheet like this. First, you have to write down assets, then fixed assets, then loan, and then owner's equity, right? So first requirement is you have to arrange it, then calculate the equity because equity is missing, and then prepare the balance sheet. This is on dated December 31st, 2017, and the answer I have mentioned here. But first you have to follow the instructions. At the end you have to tell your answer. Same thing on question number 4. Prepare the balance sheet as of June 30th of Rajing and find the missing value. What is the missing value? Mortgage payable is the missing value. Answer is here. First you have to arrange it. If it is not arranged, then you have to make the balance sheet and find out assets should be equal to liabilities plus capital, right? So these are the basic concepts of accounting. You have to do these 4 questions. After that you have to tell your answers. If still you have any confusion, anything not clear, you can write down in comment section. But please do not forget to subscribe to my channel, Sci My Academy, and thanks for watching.